welcome grade 12 accounting learners. My name is Mahesh Lal, and in today's lesson we are going to be focusing on the cash flow statement. Yes, the cash flow statement, a very important section in your exams. You're going to find that this section is normally linked with ratio analysis and can carry anywhere between 60 to 80 marks, and that is a lot of marks. So let's look at what we're going to be focusing on in terms of your cash flow statement. Some of the key concepts that we're going to be looking at today. In this session, we're going to look at, firstly, the purpose of doing a cash flow statement. In other words, why do we need to complete a cash flow statement? Who are some of the users or readers of the cash flow statement? And then we're also going to look at the format of your cash flow statement. Right, before we start looking at an actual cash flow statement, what I want to do, grade 12s, is let's look at this concept. Let's look at cash flow. What do we understand by these words that we have in front of us? So let's start with the word cash. Let's get a pen there quickly. Right, let's start by looking at the word cash. Now, when we talk about cash, or when I mention the word cash, immediately you think of money. Am I right? Yes, I am. You obviously thinking of cash, you thinking of money. And as accounting students, immediately you think of one general ledger account that is associated with cash or associated with money, and that account is our bank account. Now, for example, let's assume I've got in my bank account at the beginning of the year an amount of 1,000 Rand. Now, if you look at cash, or if we look at money, money flows in two directions. In other words, money comes in to the business and money leaves the business, goes out of the business. Money coming into the business is what we call an inflow of cash. And obviously, an inflow of cash means that the business or the owner is extremely happy. We want a lot of inflow of cash in our business. Outflow, on the other hand, money leaving the business. So an outflow of cash is obviously, we're not very happy with that outflow of cash. And that is why when we are completing the cash flow statement, you will find that we normally show the outflow in brackets. Right, now going back to this concept of cash flow. So money is coming into the business, money is leaving the business. Let's go back to your general ledger bank account. Let's assume at the beginning of the year, this business, or we have a business that has an amount of 1,000 Rand in their bank account. Now, every time the business receives money, that bank balance is going to increase. So, for example, the business receives 2,000 Rand. That is considered to be an inflow of money, money coming into the bank account. I've got more money in my bank account. Every time, however, there is a payment of cash, it is considered to be an outflow of cash. Money is leaving the business. So, for example, let's assume that we have made a total payment of 1,000 Rand. Money has obviously now left my bank account. My bank balance decreases. If I had to ask you, calculate for me, what is your balance at the end of the year? So at the beginning of the year, I had 1,000 Rand. I then received 2,000 Rand. So in total, I've obviously got 3,000 Rand of cash in my bank. However, I need to subtract my payments or my outflow of cash, which is 1,000 Rand, and I now have a balance of 2,000 Rand in my bank account. Okay, you guys are with me. Now, your cash flow statement is simply a statement that explains the opening balance and how or more or less how you got to your closing balance. So for example, at the beginning of the year, I had 1,000 Rand. Let's just extend the page a bit. So at the beginning of the year, I've got 1,000 Rand, and at the end of the year, I've ended up with an amount of 2,000 Rand. In other words, that change that occurred in my bank account, that change of 1,000 Rand, which is obviously the amount that my bank balance changed by, what we call, or we refer to this as net change. I am simply explaining to the users of my cash flow statement how we arrived at that change of 1,000 Rand in our bank account. Okay, so is everyone with me? Cash flow statement. If I had to ask you, give me a definition of the cash flow statement, your definition would be as follows. So let's move on to the next slide. Your definition: the cash flow statement reflects means that it shows the movement of cash. Movement, remember, we're talking about cash. There's an inflow of cash and there is an outflow of cash within an enterprise, within the business, during a specific period, which is normally 1 year. Okay, so this is our definition, explaining to our shareholders money coming into the business, all our inflows of cash versus our outflows of cash, and the bank balance, or the balance that we have in our bank account at the end of a financial year. Right, still with your cash flow statements, as per the Companies Act, it stipulates that a cash flow statement must be part of the company's financial statements. So remember, guys, you've already done an income statement, you've already done a balance sheet, and the third statement or financial statement that accountants are required to prepare is your cash flow statement. Right, let's move on. Let's now look at some of the users of your cash flow statement. Okay, users, in other words, who's interested in reading that cash flow statement. Obviously, management. Management refers to the company itself. Your directors forms part of management. Then your banks are generally interested in your cash flow statement, especially when it comes to the granting of loans. And then finally, investors. Investors, here we're referring to your shareholders, your existing shareholders, as well as future investors, potential shareholders, where they want to obviously see whether the company is a generator of cash. Generator means whether the company is making enough cash, or is the company utilizing their cash. Right, what we're now going to look at, grade 12s, is your cash flow statement. We're going to look at the components of a cash flow statement, and then we're going to move on to a proper example. So let's start first by looking at your format, the components of your cash flow statement. Now, when it comes to the components, you will find that there are three very important subheadings or components of this statement. The very first subheading in your cash flow statement is cash flows from operating activities. Okay, this is our very first part of our cash flow statement. Then we look at cash flows from investing activities. And then finally, the last part of your cash flow statement focuses on financing activities. Cash flows from financing activities. Let's start by looking at cash flows from operating activities. Now, let's look at the word operating. Operating obviously refers to the business itself, the core business function. In other words, where is the main source of cash coming from? So if you look at any business or any company, the main source of cash obviously comes from sales, or if the business renders a service, it comes from current income. So that is considered to be the main source of cash in a company or in a business. It involves the buying and selling of inventory meaning stock. So for example, if we look at Pick n Pay, if we look at Spar, they are constantly involved in buying stock in order to sell stock. Then you have receipts from debtors. You sell on credit. You obviously expect your debtors to pay their accounts. Payments to creditors, this obviously applies to when the business buys on credit, the business is then expected to pay their creditors. And then finally, the paying of all expenses of the business. So for example, your wages, your water and electricity, your telephone, your salaries, etc. So this is considered the main source of grade 12s. This is more or less the core activity of the business is obviously the running of the business. Money coming into the business, money leaving the business for various operating reasons. Right, let's now look at specific examples or inflows of cash versus outflows of cash when it comes to the operating activities. We first have money received from sales, which I've just explained. Then you also receive money from other income. So for example, your rent income, your interest income, commission income. The business is receiving money, hence it's considered to be an inflow of cash. Apart from the inflow, we spoke about outflows, but let's look at specific examples. Money paid for stock. If I buy stock, I have to pay. Money is going to leave my bank account, so it's considered to be an outflow of cash. Money paid for your expenses, like I mentioned, your wages, your salaries, your telephone, it's considered to be an outflow of cash. Money that is paid for tax. Remember, we spoke about this. Income tax needs to be paid to the receiver of revenue. That is another example of an outflow of cash. Then, money that is paid for dividends. When we pay our shareholders or the company pays their shareholders dividends, money is going to leave the business's bank account, hence it is an outflow of cash. Right, that was our first section of our cash flow statement. Let's now move on to cash flows from investing activities. Just want to change the color of the pen quickly. Right, the word investing. Remember, your company needs certain fixed assets or certain non-current assets in order for them to operate. So immediately we think of vehicles, we think of buildings, we think of equipment. All of these items fall under investing activities. Right, let's look at investing activities. This is the cash that changes as a result of buying and selling tangible or fixed assets or any change in investments. Here we're talking about other investments, for example, your fixed deposits. Now remember, a company not only purchases tangible assets, but after a while, that company may decide on replacing some of these tangible assets. So for example, if our computers are outdated, we are expected to buy new computers, but at the same time, we may want to sell our existing computers. So when it comes to your investing activities, there is an inflow of cash when you sell your non-current assets. There is also an outflow of cash when you buy new non-current assets. When it comes to our fixed deposits, remember guys, fixed deposits, you did this in grade 10. Your fixed deposit is where you take money and you invest it for a certain period of time. So when you're going to be making your investment or creating that fixed deposit, you are taking money out of your bank account. In other words, there is an outflow of cash. When that fixed deposit matures, that simply means that money is now going to come back into your bank account. In other words, it's an inflow of cash. Right, let's look at specific examples, which I've already mentioned, but let's look at the slide. Examples of your inflow when it comes to your financing activities: money received from the sale of your fixed assets or your tangible assets. When a fixed deposit matures, it is also considered to be an inflow of cash. Then examples of your outflows: money leaving the business, when money is paid for replacing tangible or fixed assets, paid as in the business is now buying tangible assets. Money is obviously going to leave your bank account because you are now purchasing your tangible assets. Money paid for buying new assets, and then investing in fixed deposits, investing, creating a fixed deposit. Right, that was the second component of your cash flow statement. Let's now move on to the very last component, your cash flows from financing activities. The word financing simply refers to your own capital versus your borrowed capital. Now, when we talk about own capital, here we are referring to your shares. So if, for example, the company has sold shares during the financial year, money is going to come into the business. Money is going to go into the bank account, and hence that would be considered an inflow of cash. Similarly, if the business decides to take out a loan from the bank, they will be receiving money. In other words, money from that loan is going to go into the bank account, which makes your bank balance increase, hence an inflow of cash. If the business pays towards that loan, a payment means an outflow of cash. Money is now leaving your bank account. So your cash flow from financing activity basically looks at shares, which is your own capital, as well as loans, which refers to borrowed capital. Okay, so let's look at the slide. Your cash changes as a result of obtaining finance and paying off loans, as well as by issuing of shares. In other words, again, your own capital versus your borrowed capital. Examples of inflows of cash: money coming into the bank account. Money received from issuing shares is considered an inflow of cash. Money received from obtaining loans: when you receive a loan, it's considered again as an inflow of cash. Your outflows, on the other hand, or your examples of outflows, there's one example that you're going to come across, or one transaction that you're going to come across: money that is used for repaying loans. Money is leaving the bank account. Right, grade 12s, to sum up, in terms of what we've just looked at, we've looked at your cash flow statement and the format, which is made up of the following three components: cash flows from operating activities, cash flows from investing activities, and then finally cash flows from financing activities. To sum up grade 12s, what we've just looked at is the format of your cash flow statement, which is made up of three subheadings or three main components: cash flows from operating activities, cash flows from investing activities, and then finally we looked at cash flows from financing activities. What we're going to do now, grade 12s, is I want to move on to an example where we can look at the cash flow statement, we can look at the format, we can look at the notes in much more detail, and we can obviously then start looking at exam type questions. Right, let's move on straight to this example. We've been given the following. Use the income statement and the balance sheets to provided to complete the cash flow statement of Open Limited for the 29th of Feb 2012. The information that they've provided us with: income statement for the year ended 29th of Feb 2012. Okay, so if we move down, we've got our income statement, and then we have balance sheet of Open Limited as at 29th of Feb 2012, and the balance sheet we have for 2012 as well as 2011. So immediately I've been given the previous year's balance sheet as well as the current year's balance sheet. Okay, if we move down, the next bit of information, we've got some additional information. Included in trade and other payables is 4,300 Rand in respect of SARS income tax, outstanding at the beginning of the year, and 2,310 Rand outstanding at the end of the year. Now, this bit of information is important, so immediately I'm going to make a little note in my balance sheet. So I've got 4,300 that is included in trade and other payables, okay, in respect of SARS outstanding at the beginning of the year. So this was outstanding since 2011. And then I've got an amount of 2,310 Rand that is outstanding for 2012 at the end of the year, meaning the current year. The next bit of information, the dividends on ordinary share account reflected a total of 10,000 Rand. Thereafter, the directors declared a final dividend at year end, which means this 10,000 Rand refers to or is in respect of an interim dividend that was paid during the year. The directors obviously declared a final dividend as well, but they're not giving me that amount. And then finally, the last bit of information, land and buildings were purchased during the year. So we did buy additional land and buildings. No other fixed assets were purchased or sold. So there's obviously no assets that were sold, no other assets, your equipment, no vehicles were purchased during the year except for this land and buildings. Right, grade 12s, what we're going to do is we're going to take a short break, and when we come back, we are going to look at Open Limited. We're going to look at their cash flow statement for the year ended 2012. We'll be back very soon. Welcome back, grade 12 learners. I hope you went maybe in the kitchen during the break and made yourselves a little snack. We're now ready to start with our question on the cash flow statement. Now, before the break, we looked at the actual question, the information. We're now going to complete this question on cash flow statements. Right, let's now look at the cash flow statement itself, our answer sheet. And remember, guys, right at the beginning, I explained that your cash flow statement is made up of 3 main sections. So let's now look for those 3 main sections in the statement. We start with cash generated from operations. Thereafter, we're going to be completing cash flow from investing activities. And then finally, we're going to be looking at cash flow from financing activities. So those are our three main sections. Let's now start with the very first section, cash generated from operations. In order to complete cash generations from operations, we need to complete note number 1. So let's now go to our very first note. And there's that first note. It's a reconciliation between profit before tax and cash generated from operations. We're going to start with profit before taxation. That's going to be our starting point. Now remember, profit before taxation, which part of our financial statements do we find this figure? That's right, your income statement. So let's now go to that income statement. There we go, there's our income statement, and we are looking for profit before tax. So there's our amount, profit before tax. And we're going to take this amount, 37,500, to note 1. So let's now start with this amount, an amount of 37,500. There we go, one easy mark. We now need to adjust, an adjustment in respect of depreciation as well as interest paid. Now remember guys, when we talk about depreciation, it is seen as a non-cash item. In other words, depreciation, yes, it is an expense, but the business is not physically losing money from their bank account. So although the depreciation could be, let's say, 8,000 Rand, it is recorded as your expense, but it is not seen as cash leaving the bank account. So we therefore need to make an adjustment for depreciation. In our income statement, remember we subtracted depreciation. We're now going to add back our depreciation. So let's now go back to our income statement. We are looking for under expenses, operating expenses. There we go. There's our depreciation. And for this financial year, depreciation 9,800. So now we're taking this amount back to our cash flow statement, and we are adding back the 9,800. Okay. The next adjustment that we need to make to this profit before tax is for interest paid. Now remember guys, interest paid is a cash item. It is money that is leaving your bank account. Now the reason why we make this adjustment is because interest paid is disclosed separately on the face of your cash flow statement. So it is not shown in the note as a separate item. It is instead shown on the face of the cash flow statement as an item on its own. So this item is disclosed separately. Okay, you guys with me? So let's now go to your interest paid. And again, back to your income statement, your interest expense for the year, an amount of 1,600. So we're now going to adjust our cash flow statement. Let's go back to the answer sheet quickly. There we go. Interest paid, no calculation. I'm simply taking this amount through to my note or my first note, and I'm adding back this 1,600. Now immediately guys, because this is going to be disclosed separately on the face of your cash flow statement and we don't want to forget about it, let's now go to the cash flow statement itself. There we go. And you've got interest paid. We're now going to disclose this to our shareholders that for this financial year we have paid interest of 1,600. So fill it in immediately so that you don't have to come back to this figure. Right, back to our note. So we now can adjust our profit before tax. We are now adding back our depreciation 9,800 and our interest of 1,600. So let's do that. There we go. 37,500. We're now adding back the depreciation as well as the interest, 1,600, to get an amount of There we go. Let's just get that amount back. 48,900. 48,900. Okay, that gives us our operating profit before changes in working capital. So the next step to this note is now for us to look at working capital. Now for working capital, what makes up working capital? Grade 12s, your working capital is made up of your debtors. It is made up of inventory as well as creditors, and we're now going to look at the changes to that working capital. In other words, changes to inventory, which represents your stock. We're going to look at changes to debtors as well as changes to creditors. Now, if you look at your financial statements, all three of these items are found in the balance sheet, on the face of your balance sheet itself. So let's now start with inventory. Let's go to our question. Let's go specifically to the balance sheet. Okay, don't need the calculator. There we go. Right, we're going to our question and we are looking at the balance sheet. Right, there's your balance sheet. And we are now starting with inventory. Inventory is an asset. So under current assets, there's our inventory. Now, very, very quickly, 2011 is considered to be the beginning of our financial year. 2012 is the end of our financial year. So let's now start with inventory. 2011, let's look at how much of inventory was purchased. Okay, or inventory on hand rather, sorry. An amount of 45,010 Rand is our inventory, and our inventory at the end of 2012 is an amount of 36,340. So immediately, guys, can you see there's been a decrease in inventory? And a decrease in inventory represents an inflow of cash. So let's now go to our cash flow statement. In our cash flow statement, there's obviously been a decrease in inventory. A decrease, like I just mentioned, is an inflow of cash. So let's now calculate that decrease in your inventory. We are simply looking at 2011, comparing it to 2012. And if we had to calculate that increase, or rather the decrease, not increase, 45,010, we are subtracting 36,340 to get a decrease of 8,670 Rand. So we're taking this figure now through to our note, 8,670. So there we go, decrease in inventory, an amount of 8,670. Let's just double check. There we go, that amount is correct. Now remember, guys, in the exams, we want to see bracket work. We want to see your calculation because sometimes we do make a mistake and we don't want to lose all the marks for this calculation. So in brackets, guys, you need to show me your calculation. In other words, you took this amount of 45,010 Rand, you subtracted 36,340. You must show calculations in brackets. Right, back to our note. Okay, so we looked at inventory. Now let's look at your debtors. If we go to, or if we look at our debtors in our balance sheet, we are now looking at trade and other receivables. Under your trade and other receivables, again, we are comparing, let's just quickly change the color of this pen. Okay, we are comparing 2011 to 2012. Now, immediately, can you see there's been an increase in my debtors, in my trade and other receivables? And an increase means that I'm obviously allowing my debtors to buy more on cash. Money is not coming into my bank account. So an increase in debtors represents an outflow of cash, and hence it must be shown in brackets. So immediately, guys, let's now calculate that increase. There we go. So 2011, 11,540, subtract 16,540. 580, and there's been an outflow of cash 5,040 rand. So let's now take this figure to our cash flow statement, our note. So there's obviously been an increase in your debtors. There we go. Increase must be shown in brackets, and that amount, let's just quickly look at that amount one more time. It was an amount of 5,040 rand. Okay, right, easy marks. Again, guys, you need to show me your calculations in brackets. You need to show your examiners, your markers, that you know exactly how to calculate that 5,040. Right, the last part of your working capital is looking at your creditors. Were there an increase in creditors or a decrease in creditors? Now remember, guys, if there was a decrease in creditors, that represents an outflow of cash, because it obviously means that you've been paying your creditors, and as a result, money is leaving your bank account. So let's now go back to that balance sheet. Okay, there we go. And we're now looking at trade and other payables. We're looking specifically for creditors. So under current liabilities, trade and other payables. But remember, guys, you always need to read the entire question. And that's what we did right at the beginning, right at the start, before we took that ad break. So just to recap, let's just quickly go to our information on the next page. There we go. We're looking at the very first additional information. Included in trade and other payables is 4,300 in respect of SARS, income tax, outstanding at the beginning of the year. Remember, guys, we did make a note that that was 2011. That's the beginning of the year. And 2,310 rand outstanding at the end of the year. Now, when it comes to SARS income tax, again, this is a separate disclosure. Therefore, we now need to exclude these amounts. Let's just get a pen quickly. We now need to exclude these amounts from our trade and other payables. So let's do that before we look at whether there was an increase or a decrease in your creditors. So let's go back to our balance sheet. We've got for 2011 4,300. Okay, so let's just go back to the balance sheet. There we go. Okay, so included in 2011 trade and other payables, so included in this amount, we now need to subtract that amount of 4,300, which was obviously for 2011. And then if we go back to the additional information, for 2012, we now need to exclude 2,310. So let's go back there to the question quickly. There we go, there's our balance sheet. Trade and other payables, so we now excluding, we obviously need to subtract this amount of 2,310. Right, we need to do this first and then we compare the 2 years. So let's take out our calculators. There we go. 2011, let's just fix this quickly. We've got an amount of 20,560. We're now excluding the 4,300 to get an amount of 16,260. So let's just write that amount in. Okay, I'm just going to change the color of the pen there. So this amount now becomes 26,000. Okay, I'm making a mistake there, guys. Let's just take that out. This amount now becomes 16,260. Let's just verify that quickly. Yes, that's correct. Right, let's now look at 2012. So again, let's get our calculators out. 2012, 29,130. We're now excluding the SARS amount, which was 2,310, to get an amount of 26,820. So let's now write that in. 26,820, 26,820. Okay. Right, now we can compare our creditors. So if we look at 2011, our creditors were sitting at 16,260. 2012, creditors are now sitting at 26,820. So immediately, guys, can you see there's obviously been an increase in your creditors. You are taking longer to pay your creditors. Money is now staying in your bank account, hence it's considered an inflow of cash. So let's now calculate that inflow of cash from your creditors. So we've got this amount, 26,820. We are subtracting our 16,260 to get an increase of 10,560. So let's now take that to our note. Okay, to our note. And the amount being, let's just go back there, 10,560. There's obviously been an increase in creditors, hence no brackets, it's an inflow of cash. Right, we're almost at the end of this note. Let's now calculate our cash generated from operations. So again, let's get those calculators out. There we go. So we've got this amount of 48,900. We are now subtracting 8,670. We're also subtracting, oh, sorry, guys, let's just start that over. Okay, what did I do wrong? I needed to calculate what was the changes in working capital, and I obviously left that out, meaning that this is obviously in a block, guys. Let's just make this clear. Okay, this is in a block, so I need to do this calculation first. In other words, what is my change in working capital? I'm going to just write that in for you guys, okay, because it's not filled in. So change in working capital. Guys, remember, you need to write this in full in your exams. Your change in working capital. Now let's get our calculators out. Let's now do that change. So we had an inflow, 8,670. Then we had an outflow in brackets. I need to subtract 5,040, an inflow again, plus 10,560. So my changes to working capital is an amount of 14,190. So let's fill that in, 14,190. I can now calculate my cash generated from operations. So all I'm doing, guys, 48,900 plus 14,190 is going to give me my cash generated from operations. So there we go. We've got one figure in. So let's now add 48,900 to get 63,090 rand. So let's fill that in. Okay, 63,090. Right, the first note, obviously quite a long note, very important, often asked in your exams. Make sure you get this calculation, this note, spot on correct. Let's now take this amount to our cash flow statement. Okay, so if we go to our cash flow statement, there we go, our very first amount, cash generated from operations. Let's now fill this in, an amount of, what was that amount again? Let's see, there we go, 63,090. Okay. Right, first part of the cash flow statement almost completed. Let's now move on. So we've got our interest paid filled in. We're now going to look at dividends paid and then tax paid, income tax paid. Let's start with dividends paid, and for that we need to complete note number 3. So let's now go to note number 3. Okay, I know we're skipping note number 2, but we're going to come back to that. There we go, our dividends paid. We're going to start with amount in financial statement. Now remember, guys, When it comes to dividends, the amount that is shown in your financial statements is normally found not in the income statement nor in the balance sheet, but in a note to the financial statements, and I'm talking about that retained income note. Now, if we look at the information, we've only been given an income statement and a balance sheet, but they haven't given us the retained income note, so we're forced now to go to additional information. So let's now go to additional information to try and work out what was that amount in your financial statements. So your additional information, okay, there we go. So remember guys, we've dealt with the first additional information. Let's now look at the next additional information. The dividends on ordinary share account reflected a total of 10,000 Rand. Thereafter, the directors declared a final dividend at the end of the year. Okay, so if we had to construct our ordinary share dividend account, what this information is simply telling us that we've got this amount of 10,000 Rand that was obviously declared, maybe even paid during the financial year, but at the end of the year, the directors also declared a final dividend, which immediately means that that 10,000 Rand was your interim dividend. Now remember guys, note retained income. Where you've got ordinary share dividend, that's made up of interim plus your final dividend. In other words, I need to take this total to my cash flow statement in order to calculate the dividends paid. So if I look at my interim dividend, again, the information is telling me it was an amount of 10,000 Rand, and then the directors declared a final dividend at the end of the year. Declared a final dividend, in other words, it hasn't yet been paid, and you are owing money to your shareholders. So where am I going to find this amount? Okay, very close. In my balance sheet under liabilities. So let's now go to your balance sheet. There we go. There's our balance sheet. And we're looking at the end of the year under current liabilities. There we go. Shareholders for dividends. At the end of the year, you are owing your shareholders an amount of 5,000 Rand. So let's go back to that T account. Okay, so my final dividend was an amount of 5,000 Rand, which means my total dividend that I would have taken to my retained income note is 10,000 plus the 5,000, an amount of 15,000. Right, let's now take this information to our note. So let's go back to our note. Amount in the financial statements, again, show your calculations in brackets. Remember guys, we took the 10,000 and we added the 5,000, and that is how we got this amount of 15,000. Right, now because this amount is obviously going to be paid to your shareholders, it represents an outflow of cash and it must be shown in brackets. Let's now move on. Balance on the last day of previous year. Okay, I don't really like that wording, so I'm going to change it. Balance at, let's just change the wording to read, balance at the beginning of the year. Right, again guys, we're going to find this information on the face of our balance sheet under current liabilities. What were we owing our shareholders in terms of dividends at the beginning of your financial year? So let's now go back to your balance sheet. Okay, there's our balance sheet. And we're looking at trade and other payables, sorry, not bank overdraft, shareholders for dividends. There we go. And at the beginning of the year, remember guys, 2011 represents the beginning of the year. So at the beginning of the financial year, we were owing our shareholders from previous years an amount of 10,000 from the previous financial year. So let's now fill that amount in. There we go. Okay. 10,000, and again, it's going to represent an outflow of cash, because at the beginning of the year, your shareholders obviously expect you during the course of the year to pay them that 10,000 Rand. Hence, it must be shown in brackets, it's an outflow of cash. Right, last part of your note, balance on the last day of the current year. So if we look at the balance again, guys, not very happy with that wording, so let's just change it. We're simply looking at balance at the end of the year. Okay, so if we go to balance at the end of the year, again, we're going back to your balance sheet, shareholders for dividends, and at the end of the year, remember guys, we came across this figure before, we were owing our shareholders an amount of 5,000. So let's take that amount through to our note, balance at the end of the year, an amount of 5,000. Right, this amount is not in brackets. And you're probably thinking, why is this amount not in brackets? Guys, this amount hasn't been paid to your shareholders as yet. Hence, it cannot be considered an outflow of cash. That 5,000 Rand is still in the company's bank account. So hence, it is seen as an inflow of cash. So remember, balance at the end of the year in respect of dividends is considered to be an inflow of cash. Right, let's now calculate what was your dividend that was actually paid to your shareholders. So let's take out our calculators. We've got a negative 15,000. Okay, so we've got 15,000. We then have a negative 10,000, so I'm going to add the 10,000 and then subtract my 5,000. And I've paid, or the company has paid its shareholders an amount of 20,000 this year in terms of dividends. Right, so let's now fill in that amount. 20,000 was actually paid to your shareholders, and we're going to show that in brackets because the payment represents an outflow of cash. Right, let's now take this amount to our cash flow statement. So let's go back to our cash flow statement itself. There we go. That's note number 1. There's our cash flow statement. Dividends paid, an amount of 20,000. And obviously for the calculations, the examiner is going to go to note number 3. Now please remember guys, in your exams, they might not ask you for certain notes. In the event of that happening, it is absolutely important that you show all your calculations again in brackets to earn those part marks, just in case I make a mistake with my final amount. Right, the last part of your cash generated from operations, we're now looking at income tax. So let's now go to note number 4, income tax note. Right, let's look at this note. Okay, taxation paid. How much of tax did you actually pay the receiver of revenue? Again, like we did for dividends, we are starting with amount in the income statement. So the note is actually telling us, go to the income statement, look for taxation, and bring that amount to this note. So that's exactly what we're going to do. Let's now go to your income statement. Don't want a calculator yet. Let's go to the income statement. There we go. And we're now scrolling down, taxation. There's my taxation for the year, an amount of 10,540. So let's take that amount through. Okay, there we go. 10,540 was the amount from our income statement. Now again guys, this must be in brackets because it's going to represent an outflow of cash. This is the amount of tax we should have paid the receiver, and we're obviously trying to work out how much of tax did we actually pay the receiver. So that's the amount in our income statement. Let's now look at the rest of the note. We're going to look at the balance on the last day of the previous year, or as I prefer to call it, balance at the beginning of the year. Okay, so let's now go to the balance at the beginning of the year. In other words, at the beginning of the financial year 2011, was the company owing the receiver any money? Now remember, we came across this when we were looking at additional information. So let's now go back to that additional information in our question paper, or the question itself. Additional information, there we go. So included in trade and other payables is 4,300 in respect of SARS income tax. So at the beginning of the year, we were owing SARS 4,300. So let's take that amount to our answer sheet. At the beginning of the year, 4,300 was the amount we were owing to SARS. So again, this amount must be in brackets because obviously the receiver expects you to pay this amount during the course of the financial year. Remember, this was at the beginning of 2011. We're now looking at the end of 2012. So during the year, the company surely would have paid the receiver this 4,300. It has to be an outflow of cash. The last part to this note, we're now looking at the balance on the last day of the current year. Again, guys, I just want to change that. Balance at the end of the year. And again, we're going back to that additional information. At the end of the year, we were owing the receiver. There we go. There's that amount. Owing the receiver, this amount here. 2,310 was outstanding at the end of the year. So let's take that amount through. At the end of the year, there we go, we were owing the receiver 2,310, and this amount will not be in brackets because we haven't paid this to the receiver as yet. Hence, it can't be shown as an outflow of cash. Right, we're now ready to look at the calculation and to work out exactly how much of tax have we actually paid, how much of money left our bank account to pay the receiver. So let's now take out our calculators. Okay, guys, so we've got two negative amounts, which I'm going to add up. 10,540 plus 4,300. We've got one positive amount, which I'm obviously going to subtract, 2,310. So we've paid the receiver an amount of 12,530 rand. So let's now write that amount in. 12,530 was the actual amount that we paid towards taxation. Now, please remember, guys, even for dividends, you will find that in the exam, they will tell you that a ledger account is acceptable. So instead of doing this note, you might prefer to do the SARS income tax account. Okay, I know for a fact that most of my students prefer to do the T account. So you have a choice, either to do the note or choose to do the income tax, the T account. What I want to do very quickly is show you, if you had to use the T account, how you would still get to this amount of 12,530. So let's look at this T account, SARS income tax, and I just want to change the color of my pen quickly. Remember, assume it's a liability minus plus. Let's now look at the information that we've got in the note itself. Because you guys obviously know where I've got these amounts from. So let's start with balance at the beginning of the year. Okay, in other words, you're brought down. At the beginning of the year, you were owing the receiver an amount of 4,300. So that would obviously go onto the credit side of my T account. Then, at the end of the financial year, I received my tax assessment, which I took to my income statement. There's that amount, that tax assessment. I should pay the receiver an amount of 10,540. That is my tax for the year, my taxation for the year. Now let's look at how much or what is the balance owing at the end of the financial year. So at the end of the year, you are owing the receiver 2,310. Now remember guys, at this point you should be very familiar with your T accounts, with your general ledger accounts. So my carried down at the end of the financial year, I am owing the receiver 2,310. Now the question is asking us to calculate how much of tax was actually paid to the receiver. Now remember, payments to the receiver is obviously on the debit side and your contra account is bank. How much of money was actually taken out of our bank account and paid into or paid towards tax to the receiver of revenue. So the bank amount here in this case is obviously the X, the unknown amount. So in order for me to calculate the X, all I am doing is, let's go to the side or the credit side because I've got all my known amounts. I am adding 4,300 plus 10,540 and thereafter I am subtracting my 2,310 to get my bank amount. So if I take out my calculator, okay, and if we do this calculation, we're taking 4,300 on the credit side, we are adding, let's just go back there, 10,540, and then we're subtracting the amount on the credit side, which is 2,310, and there we go. The amount paid to SARS, 12,530, the exact same amount that I've got in my note. Now remember guys, like I said, it's a choice, something of choice. You can decide, do you want to do the ledger account or do you prefer to use the note? Right, let's now take this amount through to our cash flow statement. So to our cash flow statement, let's just go back to the cash flow. There we go, cash flow statement. We've got, there we go. Right, income tax from note number 4, and our income tax paid to the receiver in brackets because it's obviously a payment and outflow of cash, an amount of 12,530. Okay, right. Cash generated, sorry, looking at the wrong heading, cash flow from operating activities. Let's now work out our cash flow from operating activities. Remember guys, this is in a block. So I can now calculate the first part or the main section of my cash flow statement. So let's get our calculators out. We've got an amount of 63,090. We then subtracting minus the interest, 1,600. We then subtracting the dividend that was paid, 20,000. And then finally we're subtracting our tax amount, 12,530, to get an amount of 28,960. In other words, cash flow from operating activities for this financial year was an amount of 28,960. Just want to double check quickly. Yeah, that's our amount. Okay, right, first part of the cash flow statement done. We've got 2 more subsections to look at. Okay, let's now go for it. Let's start with cash flow from investing activities. Now remember guys, earlier on, when I explained investing activities, we spoke a lot about assets, more specifically non-current assets, your tangible assets, your fixed assets. So we're now looking at whether the company purchased any fixed assets during the financial year. If the company purchased, it's going to represent an outflow of cash. It has to be in brackets. Or did the company sell any of its non-current assets? Were there proceeds from the sale of fixed assets? Proceeds from sale of fixed assets, money is coming into the business's bank account, and hence it's shown as an inflow of cash, and it must not be shown in brackets. Now again, we read through the entire question right at the beginning, and we did come across additional information on tangible assets. So let's now go to that additional information. Okay, additional information. Okay, right guys, I just want to quickly take this out. Okay, we're now looking at additional information. There we go. Land and buildings were purchased during the year. Okay, so there you go. There's obviously money spent on land and buildings and outflow of cash. No other fixed assets were purchased or sold. So the business obviously didn't sell any other assets, nor did they purchase any other assets besides land and buildings. So they didn't purchase a new vehicle, they didn't buy any new computers. It's only the land and buildings in terms of fixed assets that were purchased. So let's now go to our note. Okay, so we've got a note to complete, note number 5. Let's just go there quickly. There we go. Right, so land and buildings, we know from the additional information that we obviously did buy land and buildings. Immediately, I'm putting that in brackets. We'll get to the calculation in a minute. Equipment, no, I did not purchase any equipment. Vehicles, no mention of the business purchasing any new vehicles. So let's now look at your calculation of land and buildings. Now, from the information that they've given me, they haven't given me the amount that was spent on land and buildings. So I now need to go to my balance sheet. Okay, so let's go to your balance sheet very quickly in the question paper itself. There we go. Right, additional information. So I've read through my additional information. Let's now go to your balance sheet. And in my balance sheet, the only thing that they are giving me tangible assets. Okay, so tangible assets, 2011, my tangible assets was sitting at 105,000. 2012, my tangible assets is now sitting at 186,200. Now remember guys, normally you would want to say, okay, all I need to do is the difference would represent the land and buildings that I've purchased. But if you're going to do that, you're going to be making a big mistake, because you're carrying your tangible assets. What is shown on the face of the balance sheet is your carrying value. In other words, it's your book value after subtracting accumulated depreciation. So if you look at this amount is made up of maybe vehicles, cost price of vehicles, made up of equipment, cost price, land and buildings, cost price as well. And we all know from grade 10 accounting that vehicles and equipment, we normally subtract depreciation over a period of time. In other words, we subtract accumulated depreciation. Okay, so I cannot assume that if I'm going to subtract these two amounts, I am now going to get my total of land and buildings that was purchased. So let's now look at a calculation that's going to help me work out what was the cost of the land and buildings that was purchased. How much did we spend on land and buildings? So again, guys, this 105,000, a reminder, represents my balance at the beginning of the year. And remember, beginning of the year is always brought down, balance brought down. At the end of the year, my tangible assets, 186,200. Okay, that's obviously at the end of the year, and end of the year is normally seen as carried down. So let's now go back to your answer sheet. Okay, let's just go back to that note quickly, and let's now do this calculation. And I'm going to use a T account to help me calculate the amount of land and buildings that was purchased. In other words, to work out this missing amount. Okay, right, there you go. The T account that I'm going to use, I'm going to simply call it tangible assets. Okay, I know you're probably thinking, but ma'am, there's no account called tangible assets. But remember, guys, this is my calculation, might be your calculation as well. So tangible assets, it is an asset plus minus. At the beginning of the year, I will bring down a balance, so brought down at the beginning of the year. Let's go back to the question. 105,000 was my balance at the beginning of the year. Okay, so let's fill that in, 105,000. Let's now look at carried down. Again, you need to know the format of your ledger accounts. Carried down on the credit side. So at the end of the year, my land and buildings, sorry, not land and buildings, but tangible assets is sitting at 186,200. So let's fill that amount in. 186,200. Right, what I'm trying to do is construct a T account that's going to help me calculate how much of land and buildings was purchased. So I've got my balance at the beginning of the year, I've got my balance at the end of the year. Right, back to this T account. Now, what I want to do is change the color quickly. There we go. What increases tangible assets? The more I buy, the more assets I will have. So if, for example, I've got one vehicle, the moment I buy a second vehicle, my assets are increasing. I'm going to be owning more assets. The business is going to be owning more assets. So on the debit side would be that purchase of land and buildings. Now remember, guys, we don't know what that amount is. So I'm going to just put a question mark for now. Okay. What decreases your tangible assets? In other words, what goes on the credit side of this T account? Now, every time I dispose of assets, I sell assets or I donate assets, give them away, whatever the case is, I'm obviously losing my assets. So for example, I had 2 vehicles and I decide to donate one to the nearby school. Okay, my assets are now decreasing. So if there were any disposals, it would go on the credit side of this account. But remember, as per the question, we did not sell any assets. So my disposal is actually 0. Now, another very important item that decreases your tangible asset value is depreciation. Did we write off any depreciation during this financial year? Let's quickly check. Okay, where are we going to go? Correct, our income statement. We came across this before. Income statement, so if we now look at depreciation, there we go. We've written off 9,800 Rand. In other words, our carrying value, our tangible asset value would decrease by this 9,800 Rand. So let's now go back to that T account that I drew up. So we would obviously have, okay, we would have depreciation, okay, 9,800. Right, I've got everything that I should have on the debit side of my account. I've got everything on the credit side. Let's now try and find out what is this amount of land and buildings that we've purchased for this financial year. Okay, so remember, guys, always start with the side, the credit side, because I've obviously got all my amounts given to me on the credit side. So all I'm going to do is 9,800 plus 186,200. So I'm going to add, and I'm then going to subtract 105,000 to work out the land and buildings purchase. So let's get our calculators out. So we've got 9,800 plus 186,200, and I'm now subtracting 105,000 to get land and buildings that were purchased, 91,000. So let's fill that amount in. Okay, that amount is now known, 91,000. Okay. It's easy. It's really, really simple. It's not a difficult calculation. So let's now take this amount to our note. There we go. Land and buildings purchased, and we're filling in 91,000. Remember, guys, again, you need to show your markers, your examiners, a bit of calculation. It is very difficult for them to go to this T account, to look at this T account. So let's now show our calculations in brackets. So how did we get this 91,000? We use these two amounts, so 9,800. We then added 186,200, and we subtracted 105,000, and this is how we've got our 91,000. Okay, right. tangible assets purchase, so we don't need a calculator for that. We've spent 91,000 on tangible assets. Again, remember, it must be in brackets. It's an outflow of cash. Let's take this 91,000 to our cash flow statement itself. So there we go. Cash flow statement. Proceeds, sorry, not proceeds, purchase of fixed assets, note number 5, was an amount of 91,000. Okay, proceeds from sale of fixed assets, we didn't have any. So again, guys, this is a block. Okay, 91,000 plus 0, there's nothing there. So my cash flow from investing activities is an amount in brackets of 91,000. Let's just fill that in. Okay, now remember, guys, cash flow from investing activities, flow meaning money coming in, this should actually read cash utilized. Okay, utilized cash that was used for investing activities. Right, so we've now done with cash flow from investing activities. We're now moving towards the third main section in our cash flow statement, cash flow from financing activities. Now remember, guys, when I explained earlier on financing activities, here we're looking at, has the business issued more shares? If the answer is yes, it means that money is going to come into the business's bank account. It's going to be an inflow of cash. Has the business taken out another loan or increased its loan? Again, if the business has borrowed capital or borrowed cash, money is going to go into the bank account, and hence that increases the amount of money that you have in your bank account. It is seen as an inflow of cash. If the business, however, decided to pay towards its loan, that is considered to be an outflow of cash, a payment out of your bank account, money leaving your bank account, that is going to be shown in brackets. Right, so let's now look at cash flow from financing activities. We're going to start with proceeds from shares issued. Has the company issued shares during the financial year? And again, back to our information, back to our balance sheet. So in our balance sheet, we are now looking at the equity section of our balance sheet. Ordinary share capital. Remember, a company can also issue shares at a premium. So these are the two accounts or the two amounts that we need to look at. Let's start with ordinary share capital. Beginning of the year, this was our ordinary share capital, 100,000. End of the year, our ordinary share capital has increased to 150,000. So obviously, guys, the company has issued shares during the course of the year, and ordinary share capital, they've received an amount of 50,000. 150,000 minus the 100,000 gives me that inflow of cash, 50,000. Let's now look at where the shares were issued at a premium. Share premium, 2011. I just want to change the color of the pen quickly. 2011, my share premium was 8,000. 2012, my share premium is sitting at 15,000. So this company has issued shares at a premium meaning higher than par value. And if we look at the difference, shares were issued at a premium of 7,000 Rand. So immediately, guys, your total proceeds from the issue of shares is my 50,000 plus 7,000 to give me a proceed of 57,000, and that's what I take to my cash flow statement. So let's now go to your cash flow statement. Proceeds from shares issued. Right, so let's fill that amount in, 57,000. Okay, again, guys, I know I've said this before, you've got to show me calculations in brackets. So in brackets, how did we get the 57,000? Our ordinary share capital increased by 50,000. Shares were issued at a premium of 7,000. That is how I've got a proceeds from shares that were issued during the financial year, 57,000. Right, let's now look at the second part of your financing activities, we're now going to look at your loans. And again, guys, for your loans, we're going to go straight to your balance sheet. Okay, you knew that. Right, your balance sheet, we are now looking at non-current liabilities. We're looking at this mortgage loan. Okay, again, let's now look at your mortgage loan. 2011, the company was owing 10,000. 2012, the company is owing 5,000. So obviously, there's been a decrease in this mortgage loan. A decrease meaning that the company has paid towards this long-term liability. How much has the company paid? 10,000 minus 5,000, the company has paid back 5,000. If the company is making a payment, money is leaving the business's bank account, hence it's seen as an outflow of cash. So if we now go to our cash flow statement, there we go. Payment of long-term loan, so let's fill that in first. Payment of long-term loan was an amount of 5,000, and this is obviously in brackets, outflow of cash. And again, guys, how did we get that 5,000? We took 10,000 minus 5,000, and then we've got that amount of 5,000. Right, the last part to your cash flow from financing activities, proceeds from long-term loan. Did the company increase its loan? No, the company didn't. All the company did for this financial year was pay towards its loan. So there's obviously no proceeds. Proceeds means, did the company take out another loan, an additional loan? So proceeds, we're going to fill in that amount of 0. Right, again, I've got a block here. Okay, I know you guys can't see it very clearly, but this is a block. 57,000, I've got a negative amount, so I must subtract 5,000. And my cash flow from financing activities is an amount of, don't need your calculators for this, is an amount of 52,000. Okay, right, guys, almost towards the end of the cash flow statement. Remember, the purpose of the cash flow statement is to find out what was the net change in that bank account. What was the net change in your cash and cash equivalent? So that's what we now can calculate, your net change in cash and cash equivalent. How are we going to calculate this? We are now going to look at the following 3 amounts that we've already calculated. So I just want to quickly change my pen. Okay. Right, we are looking at cash flow from operating activities. So that's our starting point. Let's get the calculator out and let's enter this amount, 28960. Okay, if we now go further down, we then worked out your cash utilized on investing activities, which was this amount here, 91,000. So let's now remember, guys, that's in brackets, so we need to subtract 91,000. Okay, we then looked at the last part of our cash flow statement, cash flow from financing activities, 52,000. So a positive amount. Let's get the calculator back. So plus 52,000. Right, and our answer, 10,040. Okay, so let's now fill that in, cash and cash equivalent, or changes in cash and cash equivalent, an amount of 10,000. Okay, it's a negative amount, guys, so in brackets, that amount of 10,040. Right, now what I want to do is, I do not want to complete note number 2, okay? Doesn't mean that that note is not important, but let's now look at, because we're running out of time, let's now quickly look at the very last 2 calculations. Cash and cash equivalent at the beginning of the year, and then cash and cash equivalent at the end of the year. Now, if I look at cash, cash is obviously shown in my balance sheet. So let's quickly go to that balance sheet. Okay, there's my balance sheet. Right, there we go. Our cash and cash equivalent for 2011 was an amount of 200 Rand. 2012, it's 300 Rand. Okay, but if we look further down, because remember, we cannot forget about bank overdraft. We've got a bank overdraft. Let's just quickly change the color of this pen here. There's our bank overdraft. 2011, 11,400. 2012, our bank overdraft, there was an increase, 21,540. So if we look at cash and cash equivalent at the beginning of the year, remember, beginning of the year was 2011. Let's get those calculators out. So you've got a negative amount of 11,400, and then at the top, okay, if we just scroll up very quickly, at the top, we've got a positive amount of 200. Okay, so all we're doing, guys, on our calculators, there's my positive 200, and then I am subtracting, because I've got a negative amount at the bottom, a negative amount of 11,400. So minus 11,400, and my cash and cash equivalent at the beginning of the year was a negative amount, because it obviously was an overdraft, 11,200. So let's take that amount through. Okay, there we go. 11,000, what was it again? 200. Right, let's now look at what was your cash and cash equivalent at the end of the year. So again, guys, we're going back to that balance sheet. At the end of the year, I obviously had cash and cash equivalent, a positive amount of 3,000. There we go. And then we also had a bank overdraft of 21,540. So again, on our calculators, we had that positive amount of 300 minus my overdraft, 21,540, to get 21,240. It's a negative amount, got to be shown in brackets. So that was my cash and cash equivalent at the end of the year. So let's now fill that in. At the end of the year, your cash and cash equivalent, and there you go. I forgot to put this in brackets. Let's just put that quickly in brackets. We've got that negative amount of 21,240. 21,240. Okay, so if I had to ask you what then was the net change in cash and cash equivalent, this was my cash and cash equivalent at the beginning. This is my cash and cash equivalent at the end. So as we can see, your bank overdraft obviously increased, isn't it? So the difference, 11,200 minus 21,240. So your bank overdraft, there was a change in cash and cash equivalent. Let's get that calculator back, 10,040. And can you guys see the amounts are exactly the same? So in other words, if we did complete note number 2, this is the amount that we would end up with. Right, guys, we've done quite a bit on cash flow statements, and I know you're probably thinking I've only done one question, but why am I saying quite a bit? That's because we've done an entire cash flow statement with most of the notes, most of the calculations. Remember, guys, practice makes perfect. The more questions you practice, the more cash flow statement questions you practice, the better your results or your performance when it comes to the cash flow statement in your exams. Until next time, grade 12s, good luck, God bless, goodbye, guys.